I'd like to welcome everybody to this episode of The Complete Advisor. We are joined by a repeat guest and a great guest, Erik Bowman. Erik, great to have you.
Thank you, Dennis. Always good to be here.
Now, the topic that we're going to talk about today, our topic is the 5 questions that you as an advisor have to have an answer for. The 5 questions that you're going to get from clients that you absolutely prospects. The questions you're going to get from prospects. Your clients should know this.
Prospective clients.
Prospective clients. So we're going to talk through the 5, and what I'm going to do, what I want to know, Erik, I want to know how you answer these. And so I've got this article that I grabbed them from, and I was looking through them, and this article actually has 12 in our conversations. A couple of them seemed like repeats, so we narrowed it down to 5. Also, I do want to remind you, would love it if you would hit that subscribe button to The Complete Advisor. You can watch us on, even though it's a podcast, you can watch us on YouTube, Spotify, Amazon, or you can listen to us on those. You can listen to us on iHeartRadio, Pandora. We're on Amazon. We're on Google. You can find us anywhere, but I would love if you subscribe, then you get notified when there's a new episode. Also, I would love your comments because I read them and I respond, and anything to make the podcast better, even if it's constructive criticism and it hurts, I'll take it, Erik.
Sounds good.
Yes. Okay, so our topic, 5 questions that you're going to get from a prospect that you need to address. And I say it that way because a couple of these, you and I were talking off mic, we were talking about the fact that some of these need to be handled. There's 2 ways to handle these, either a direct question or in conversation with that prospect when you're talking about who you are.
I would say if you have a process, if you run your meetings in a consistent fashion, those questions will naturally get answered even if they don't ask. Mm-hmm. If they ask them a little prematurely, you learn how to address those appropriately. But one way or another, the answer has to come out.
Because if you don't address it in that first meeting, it's coming up sooner or later.
Yeah, well, the worst way it comes up is they don't ask, you don't tell them, and then they go back to their current advisor, and they have a gap in their knowledge of maybe what you provide, or they have an objection that did not get answered, and it prevents them from moving ahead. So there are some just mandatory answers that have to get out there.
Things you have to cover. All right, let's hit. So 5. We're going to talk about the 5 that you have to cover. Number 1. What are your qualifications?
What are my qualifications? Well, in my seminar, I actually address that because I have about 2 slides where I talk about me and my firm and my family, and then the rest of it's about them. And basically, I say I have the RICP, that's the Retirement Income Certified Professional Designation, which is an 18-month curriculum that focuses in on the needs and challenges of those people that are at or near retirement. Then I'm a certificate holder of the National Social Security Association, which is a deep dive into how Social Security is calculated, a lot of the marginal issues that pop up here and there, but also strategies and tactics to make better filing decisions, and a lot more than that too. There are a lot of challenging situations that can come up when you deal with Social Security a lot. I like those for my practice because that's what I do. I'm a retirement planner. I don't work with a 40-year-old with a Roth IRA. I only work with those transitioning from accumulation to distribution. So the RICP and the NSSA are extremely relevant, both in what they sound like to the client, which is important, but as well as the material itself. I think is important.
I was going to ask you that one right there. There are a ton of different designations and alphabet soup that you could go out and find. And in fact, I had to scroll on while we were talking. I'm like, wait, I can't remember what that designation is that I have.
Right.
So I went to look. I'm not going to say, but it's amazing when you can get out a box of Cracker Jacks. But with all those qualifications, it is interesting that there are some that resonate more than others. And I know that in particular, I've been hearing that designations that relate to Social Security and then taxation have been really big. Really resonate.
I'm actually taking another set of credentials here in the next year that's a focus on taxation. So that's another one, and that's important when it comes to efficient taxable distributions for retirees. But I feel like there's more to learn. There's always more credentials to get.
Correct.
I'm not in a race, though, to just fill as many acronyms. I mean, I am running a practice. Here's another good bit of credentialing I have is my anecdotal experience as a financial advisor with over a decade in the industry working with people just like them. That has offered a pretty good amount of learning. As a matter of fact, the analogy I give when I'm talking to other advisors is when I think about college, I hate to say it, so pardon me, University of Colorado, I don't think I learned a thing that I apply right now. Everything has been on-the-job training, and what I have learned through mistakes I've made, successes I've had, and the repetitions of meeting with clients and creating plans has really been the enduring learning that applies to.
You know, it's funny. There was a book. I'll remember the title. I didn't read it, but I know what it's about. But it was called Fail Forward.
I know the concept.
And so that's what I think is funny. Is I hope the book falls in line with what I think the concept is, because I've definitely failed forward.
It's the only way to go, actually. I mean, I know this is a sidebar, but the idea of trying to get somewhere without failing along the way is the surest way not even to get there. I mean, it is the failures that you learn by, and they are the best teacher. There's no question about it. And you think of somebody like Elon Musk. There's nothing like a rocket that doesn't make it into space. He's like, look at how much we've learned. Yeah. You know, that's the attitude you must have if you want to succeed.
This is true. Okay, so the qualification question. I want to ask it. I'm going to throw this back to you in two different ways.
Okay.
So I know that you do a lot of seminars.
Correct.
So in a seminar situation, you are throwing your credentials. This is who I am.
Absolutely.
What about situations where it's a referral, where somebody's not in a group setting to where you're automatically, maybe they ask you this question?
Well, if we're like in an initial fit meeting and it's a referral that comes in, I usually will explain a little bit about what we do in the firm, so they have the context of why am I asking certain questions,
Gotcha.
What is it that I provide, and then you can learn how to wrap really efficiently your designations and things that make you an appropriate planner for that person, like the RICP and the NSSA, and I just talk through them. I just mention them and I talk about them, see if it raises any questions. And then I don't sit there and dwell on them. I get them on the table so they understand I've put in due diligence to make sure I know what I'm talking about.
You don't show them on the wall?
It's right behind them. They can't miss it.
Okay, so that was number one. Number one is, what are your qualifications? Number two, and this dovetails right into where we're at there with the fit meeting, what is your investment philosophy? Investment philosophy.
That is a good one, and you do need to have one for sure. You just, I don't think it can be some general idea of we want to try to make a rate of return. I mean, our philosophy is, number one, we know that we need exposure to the marketplace. That's a general term that covers stocks, bonds, other asset classes, so that we can get a rate of return so our assets can last as long as we need them to last, and some positive rate of return will help with that. When it comes to the actual investing and creating portfolios, I'm a believer in ETFs, exchange traded funds. Many times I have to explain what an ETF is. They might have heard of mutual funds, but not ETFs, so I can really quickly explain that. And I literally on the whiteboard will draw a portfolio, a little 60-40 only as a representative example, and say, ETFs are one of the best ways to get broad-based exposure to a multitude of asset classes at a low internal expense, because ETFs have an expense ratio just like mutual funds, but they happen to be less expensive. So part of the investment philosophy is keeping fees low, because if you reduce the fee, you've increased their net rate of return, which is what ultimately we're seeking for them. Then I go a step further and say that in certain cases we're going to use option strategies, so I use structured notes that might replace portions of what would otherwise be an ETF component of the portfolio, and I'll walk through briefly how we utilize those. And the bottom line is, when I use option strategies, my goal is to seek diverse ways of getting rate of return but reduce risk. You can use options to increase risk. In our firm, we only use them to reduce risk, because the number one investment risk my clients have is sequence of return risk, that being making distributions from an account that's dropping over time. So that means we're not just trying to seek the highest rate of return. If somebody needs an 8% guaranteed rate of return for a successful retirement, there's problems. We're typically trying to seek about 4%, a little between 4 and 5. And then I'll even talk about the annuities, because that's our kind of stop loss, if you will. The annuities provide that zero fee, so we're meeting the fee principle, a 0% guaranteed loss structure, which is going into, we're not trying to seek the highest rate of return, but we need a place where we can offset sequence of return risk, have an alternative distribution source, as well as seek positive rate of return when the markets are going up.
So let me ask you this: with when you're talking about your investment philosophy, there's a lot of things that are out there. As far as I'm gesturing because I just had this conversation in a room here with a couple of advisors. But are there investments and are there limitations on what you will consider or recommend? Crypto, physically holding gold, nickel. I mean, we were in a pretty wide conversation here.
Those questions do come up. So from a principled perspective, we never touch anything that's speculative. In my opinion, from every definition, crypto is speculative. Therefore, we don't put it in place. In 2020, we had a lot of people that wanted to ride that train. And I said, if you want to do it with your own money, that is not the way I do investment planning for retirees. Regarding physical gold, if they're advertising it on the radio and they're saying buy your gold now, that should raise a red flag, I think, right there. But here's the bottom line on physical gold. You own physical gold. Theoretically, it's a safe haven in certain markets. It doesn't always correlate like that. The minute you buy it, you've lost money because of the spread. In order to say, if you've ever watched anybody actually conduct the transaction in full circle, they're buying the gold. It's immediately worth less the second after they purchase it because of the buy versus the sell. And then when they want to sell it, most typical firms that work in that space make you send them all your physical gold first. They'll put a price on it and send you back an offer, and then you have to decide if you want to do it or not. Now let's imagine it really hit the fan. The whole economy is down in the dumps. Everybody's living in their basement, beans and bullets. What are you going to do with gold?
Throw it at somebody?
Yeah. What are you going to do with gold? The primary use of gold right now is electronics and jewelry.
Yep.
And so anyway, I think that's enough of a reason. It just doesn't make a whole bunch of sense. And what was the?
Well, that was kind of nickel. I mean, the same thing. Precious metal.
Yeah. But REITs. I know some people like real estate investment trusts. I personally don't. In retirement planning, the lack of known liquidity timelines is a challenge. Also, we've seen the pendulum swing on commercial real estate, which could make REITs not necessarily the best choice. Yep. So I've stayed away from REITs. But you know what I tell them? I evaluate them every year. I look to see what the market looks like, what products are available. I'm licensed that I could actually represent those. I just think that the variables associated with liquidity, rate of return, concentration risk outweigh the desire for me to put them in a plan.
Do you hang on to them when somebody comes over and you bring their assets over? Do you hang on to them? And
don't have a choice. Can't get out of them.
That's true. That's true.
I do help people when the annual buyout offers happen, help them evaluate those offers and then help them conduct the transaction to get out if it makes sense to do it.
Nice. All right, well, let's move on to number 3. So we've covered what are your qualifications. We've talked about investment philosophy here. And I know this one comes up because you see it all over the place. It was.
Can I go back to one thing on investment philosophy? If you really were to give it the high arc on investment philosophy, it's we want to find the lowest cost way to get diversified investment exposure because diversification is the watchword for risk reduction. And when it comes to retirees, we approach this not from how can we get you the most return. We approach it from what's the goals-based rate of return. So in our plans, if we're using 4.8% gross before fees, and then we net out the fees inside of our planning software, we're trying to find the mix of assets and exposure that can give somebody a realistic chance of getting that rate of return, not trying necessarily to exceed that with higher risk investments that don't meet the bill.
I've just got to think that anybody, if you're serious, how could you not have an investment philosophy? Because if I came in as a client, I would want to know the answer.
It's the first thing I talk about when I go over what we do here in the office.
Yeah. Okay. This would be number 3. Are you a fiduciary?
I am a fiduciary. Very common question that people ask. But what I think is interesting is when people ask that question, I don't think they know what it means. They're asking it because they read an article in Forbes that said you should ask and make sure your advisor is a fiduciary. And they're like, well, I better ask that. They still don't know what it means. I address it in the seminar. So it's it's a list of items about my background, and one is I operate as a fiduciary. Obviously, the fiduciary rule is a best interest rule that contrasts to a suitability rule. The way I describe that is when it comes to a suitability or a suitable recommendation, there's a multitude of suitable recommendations. Best interest says is this the best recommendation, and then contrast it to the recommendations you're not making. Like, I looked at this, I looked at this, and I looked at this, and this is the one that I recommend, and here's why I don't recommend those. That is one of the aspects, I think, of communicating to a client that can highlight the fiduciary role a little bit better.
Yeah, they just want to know it. Because, like you said,
they just want to know if you're a fiduciary. And now the question will be, why? What makes you a fiduciary? Well, I mean, it actually has specifically to do with how you're paid. So if you're like me, I'm an IAR working under CreativeOne Wealth. I get paid an ongoing fee for managing those assets. That immediately locks me into a fiduciary responsibility. If you're insurance only, in the past, that would mean that there was no fiduciary responsibility, a single transaction and you're done. My understanding, though, is they're starting to adopt the legislation in that no matter where you are in the financial industry, that you're going to have to act as a fiduciary, even if you're insurance only. I'm not sure exactly where that is right now.
It's still up in the air a little bit because there's a place in there's best interest, place, and time.
Yeah,
and then there's ongoing. That's a whole different ballgame, whole other podcast. Okay, so we've talked about. Let me make sure I'm not missing anything. What are your qualifications? What's your investment philosophy? Are you a fiduciary? Next one. How often will you communicate with me?
I say I will communicate with you 3 times. The first one is whenever you want. The second one is when tax law changes and it impacts you, then I'm going to reach out. And the third one is by the calendar. I have a fiduciary responsibility to meet you no less than 1 time a year. We, of course, meet our clients more than once a year. That's my simplistic approach to it when they ask, how often do we meet? Then after I get that on the table, and that wakes them up a little bit, and they kind of like that whenever you want, then determining the pace of meeting, which is unique to each client.
Sure.
So, high net worth clients, we could meet as many as 3 times a year, maybe even 4 times a year. Some clients we meet less often, but bigger meetings. Other clients just want to stay in touch, and we'll have a 30-minute call once a month. So it really does depend what the client wants. But the bottom line is we'll meet you 3 times. 1, whenever you need it. Number 2, when tax law changes or legislation change of any kind that impacts your investments and the strategies we've deployed. And then the 3rd time is by the calendar to meet at least the minimum obligation.
Yeah. So you know what? The one thing before we get to number 5, we're already to number 5. The thing that I'm picking up from the way you do things and the way that an advisor should be doing things is that you have the choice. I'm going to go sports analogy.
Sure.
You have the choice to be on your heels, be a defensive, taking these questions and trying to you're responding versus you're taking it's not so much the initiative, but you are controlling the conversation and the framing of these questions because you're addressing the concerns. This is classic, handle the objection before an objection comes up. But give them the information that they're going to be asking because you've got these years of, I can't think of the acronym because you shot it out there so quick, all those years of working in the industry.
Oh, I don't even remember what acronym we're talking about.
You didn't have one. You just said, I also have, we were talking qualifications.
Oh, okay.
About 10 years.
The RICP and.
But then you had that whole thing about you.
Anecdotal.
Yes, that whole, I was trying to do an acronym in my head and you just lost me. But so being able to answer these questions. So the last question, and I know that this one can give some advisors fits. And so I'm going to put it out there for you. In fact, you must handle it very well because I can see you're searching your memory.
I don't need to search at all. I'm going to give you the one. I'll tell you what I say when I need to lighten the mood. I know the question you're going to ask.
How do you get paid?
Just write me a check for $1 million. It'll cover everything. No,
nice.
I don't. So, I'm paid 3 ways. The first one is if I create a retirement plan, I may charge a fee for that retirement plan. So that would be a one-time fee. That's one way I'm compensated. The other way I'm compensated is through insurance products. So if I place either life insurance, long-term care, or an annuity, which is a product from an insurance company, I'm going to be paid a commission from that company. It does not reduce the value of your principal. It comes from their predicted profitability. And then the third way is if I manage assets, I have an advisory fee that I charge on an annualized basis.
Nice. And this question of how do you get paid, it really isn't, in my mind, the question isn't, the client's not asking how do you get paid. What they're really asking is what am I paying for? A
lot of times they're seeking to say or to understand, is your fee going to reduce my money? So I don't think we want to just assume that it means, because the value proposition is actually critical. And this goes to all 5 of these questions. there's a time and a place for each one. Like when I first meet somebody and I'm going through the discovery, I'm not talking about how many times I'm going to meet them when they become a client. We haven't even gotten to meeting 2 yet.
Sure.
So sometimes they might bring these up ahead of time, meaning when it's not necessarily appropriate within the context of the goal of the meeting. And if they do, I'll give them a short answer and say, what I think would be a good course of action today is to focus on what I've promised you. And what I've promised you today is to do a good discovery so I can provide you complimentary analysis in meeting 2. But I don't want to ignore the question. So I'll give them a brief answer and they'll say, okay. And I go, but we'll address that more because there's a good chance we're going to continue this engagement process. And I can promise you that all of that information is going to be fully transparent. I'm going to make sure all of your questions are answered.
Nice. So I think the 5 questions again, and I like the way that you handle it because again, instead of meeting with someone, looking at them and letting them pepper you with questions, you're basically, and this is what you coach people too, is
Sure.
Answer these questions, tell them who you are, tell them what you are, tell them why you are, and that probably covers a lot of things. So the 5 questions that we hit today, that we talked about, the 5 questions that are going to come up with a prospect.
Right.
What are your qualifications? What is your investment philosophy? Are you a fiduciary? How often will you communicate with me? And then lastly, how do you get paid?
Yeah, I think that there's one more piece that might fall under qualifications and how we're paid or fee structure, all right? And I think it's important to understand that there's a couple ways a client may enter in where you need to talk about the regulatory hierarchy. And that regulatory hierarchy is extremely important. The way it connects to the fee structure is that we have not only the advisory fee I charge, but there's a platform fee for the RIA, for CreativeOne Wealth.
That's a good point.
So they're charging that fee. I may not be getting that, but it's not a fee we can ignore because it's a legitimate fee that's deducted from their assets.
And it's going to be on their statements.
And they're
going to ask you about it.
It's going to show, well, it's actually one line item called advisory fee that includes mine and it includes CreativeOne Wealth. So it's not actually broken down, more of a reason to really talk about it too. But it brings up then the regulatory hierarchy because if CreativeOne Wealth is charging a legitimate fee, there better be some value there, and there is. So that I say, I can explain this fee structure to you if you give me one moment to talk about the regulatory structure and the hierarchy. Then I'm on the whiteboard drawing the Securities and Exchange Commission up at the top, and I actually get to talk about a little experience I had where I had 2 field agents do a 2-day audit in my office. No findings at all. It was a great experience, and it went well. And then next is the RIA, CreativeOne Wealth, and then IAR, Investment Advisory Representative, which is me. As an IAR, I must work with an RIA to be able to do business. I can't just work directly with an individual on the street without being affiliated with an RIA. Now, what does the RIA provide? Well, the first thing they provide a bunch of lawyers and compliance folks to make sure that I'm doing my job the right way and that I'm in compliance with all federal law. So very important for you, client. That's a very important aspect of this relationship. In addition, that's where the operational team is. My trade desk is there. They've created a special website that you're going to be able to access when you become a client that has really good performance reporting and other data that you're going to find relevant. I'm in that portal every single day. That's where I place trades, analyze portfolio performance, and much more. So they do a lot. So I write on the whiteboard, lawyers, compliance, operations, trade team, my link to the Securities and Exchange Commission. They also have an institutional relationship with the custodian. So in this case with me at Schwab. Therefore, I have an institutional relationship with Schwab. No trade fees, except for international, ADRs, things like that. But basically, no trade fees. So I gain the benefit of the relationship with them to allow me to use a large custodian like Schwab with all those built-in efficiencies. So another way you can get there is, here's a client. How do I know you're not Bernie Madoff?
Exactly.
You'll get that question, and they're usually apologizing before the words come out of their mouth, and then they're apologizing afterwards because it is quite an insinuation if they're trying to insinuate anything. But I know what they're trying to get at is how do they know their money is safe?
Exactly.
And the way to answer that one is when people worked with Bernie Madoff, who did they write the checks to?
Bernie.
They wrote them to Bernie. When you work with me, you will never, under any circumstance, write a check to Erik Bowman or Bowman Financial Strategies. It always is written either to the RIA, in the case of a plan fee, or directly to the custodian or insurance companies. There is never any money held at this office. But clients don't know that. Like for all they know, we have a vault with money, and they don't know. And so I'm explaining to them clearly, no money ever passes through our hands. It's direct to the custodians and the insurance companies, and that's an easy way to alleviate that one. Is who do they write the checks to?
Yeah, you'll have to when we're done. You're going to have to show me the drawing you do because I love
sure.
whiteboard. I would like to see that.
I'm going to add one little piece here, just like a tactic that all advisors should learn how to do, whether it's whiteboard or on the TV screen. They have to come up with ways of communicating a lot of these very succinct messages that have to what's my investment philosophy? What are my accreditations? What do they mean? And you need to have a way that you've used time and time again that you know what you're talking about. I use the whiteboard. I love the whiteboard. And every one of those things we spoke about has an associated illustration that I do on the whiteboard that helps clients understand it better. And I'd recommend if you get asked one question one time, you got to figure that one out. Mm-hmm. The second time you get asked a question, if you don't know the answer, you've kind of made an unforced error.
That's a really good point. And I like something you just said about it being succinct, because you can, if a client asks you a question or a prospect asks you a question, and it is something you should know.
Right.
If you're fumbling around, you're eroding your credibility.
Absolutely.
All your chances are going out the window.
Yeah.
All right, so here's what we're going to do. I want to re-say those 5 again that we talked about today, and I'm checking my sheet here. What are your qualifications? What is your investment philosophy? Are you a fiduciary? How often will you communicate with me? And then how do you get paid? Those are 5 questions from prospects that you have to have an answer to, whether you have a direct answer to whether it comes at you in the form of a direct question, because it could happen at a cocktail party.
Absolutely.
Or when you have somebody in your office and you have the ability to go through your track that you have where you answer these questions ahead of time.
Yep.
Eric, thank you so much for being on the podcast. For everybody else, please, if you get a chance, subscribe. It's right there. Just click it right there, subscribe. That way you're always in the know when we drop a new episode. At the same time, please feel free to use the comments. I read them, good, bad, and different. I really like the bad ones, kind of, because then you hear what I need to work on.
That's where you learn.
That's right. That's where you fail forward, right?
Yep.
But I also read them. I'm also looking for suggestions for ideas for different episodes. But you can find us anywhere that you like to consume podcasts. So The Complete Advisor, we look forward to seeing you on the next episode.